Picture yourself heading out to your mailbox on a typical afternoon, sorting through store circulars and service bills, when you notice an official letter from the IRS. A sense of unease creeps in. You unseal it, thinking perhaps it's just a standard notification, but instead, you're looking at a fine $10,000, and the hardest part, you're completely clueless about what triggered this. You didn't conceal funds internationally. You didn't operate an undisclosed enterprise. You didn't falsify your tax documents. All you did was deposit some cash from your pickup sale. Perhaps your child sent you funds to assist with healthcare costs, or you transferred money around to finally fix that aging roof. Entirely typical retirement transactions. However, in 2026, typical doesn't necessarily mean protected, because what's causing these fines isn't unlawful conduct, it's sequences. Sequences identified by computerized platforms that don't understand your circumstances. And when that platform determines something appears questionable, the fine can begin at $10,000 for one single infraction. Right now, we're going to break down precisely what's occurring, why numerous retirees are being taken by surprise, and the one basic error that can transform an innocent banking visit into a government issue. Hello, I'm Sophia, and I dedicate my efforts helping retirees safeguard the savings they worked their whole lifetime to accumulate. And I must discuss with you something that has silently transformed in the banking world this year. The regulation itself isn't recent. Actually, it's existed for many years. But the manner it's being implemented in 2026 is entirely different, quicker, computerized, and much less accommodating when something doesn't align precisely. My purpose today isn't to alarm you. It's to ensure you comprehend what's actually happening, what kind of ordinary banking activity can cause a substantial fine, and critically, how to safeguard yourself so you never encounter that $10,000 shock. Because when you understand how this operates, you'll recognize the risk isn't apparent. And that's precisely why we must discuss it. So, let's begin with the aspect that's catching individuals completely unprepared. The ordinary transactions that appear totally innocent initially. Imagine this. You sell your old pickup vehicle for $15,000 in cash. The purchaser arrives, counts it out, and you travel to the bank to deposit it. Straightforward. Or perhaps your son transfers you $20,000 to help handle some unanticipated healthcare costs. Or you finally accept that single-sum pension distribution you've been considering for years, or you transfer a substantial portion of savings from one account to another because you're making a down payment on an RV. None of that is unlawful. None of that is questionable. It's just existence. It's retirement. It's your funds. But here's where circumstances start to change in 2026. Banks aren't simply holding your deposits. They're documenting certain kinds of activity automatically, and those documents don't remain in a storage cabinet somewhere gathering dust. They're being examined, categorized, and compared by platforms that are created to locate discrepancies. So, when a substantial amount of cash unexpectedly appears in your account, the platform doesn't recognize truck sale or gift from child or retirement distribution. It recognizes numbers. It recognizes sequences. And if those sequences don't correspond with what's on your tax documents or other monetary records, it raises a digital flag. This is the aspect that feels unjust to numerous retirees because from your viewpoint, you're just handling your finances responsibly. But from the platform's viewpoint, it's asking one very particular question. Where did this money originate, and was it appropriately documented? And if the response isn't absolutely clear in the information it has available, that's when difficulties can begin. Now, here's the element that surprises nearly everyone. The regulation behind all of this isn't recent, not even remotely. Actually, it's existed for many years. What's transformed is how intensely, and how capably it's being implemented. At the foundation of this is something called a Currency Transaction Report, or CTR. And despite how concerning that sounds, it's actually very simple. By regulation, banks are obligated to submit a CTR whenever someone makes a cash transaction over $10,000. That encompasses cash deposits, cash removals, even particular kinds of transfers. So, if you enter your bank and deposit $12,000 in cash, The bank completes a form and submits it to the government. You don't complete it. You don't even necessarily observe it. It occurs behind the scenes. And here's what's significant. A CTR is not a fine. It's not an allegation. It's not a sign you did something incorrect. Millions of these documents are submitted every year. For many years, this has been standard. Business proprietors deposit cash. Individuals sell vehicles. Families transfer money around. The bank submits the form, and existence continues. So, if that's been the regulation for years, why are retirees suddenly learning about $10,000 fines? Because previously, these documents mostly just remained there unless a human examiner had a reason to investigate further. Today, that's no longer the situation. Now, those CTRs are immediately entered into computerized platforms that evaluate them against tax documents, Social Security files, pension distributions, and other monetary information. The platform isn't just gathering information anymore, it's evaluating it in actual time. And when it locates something that doesn't align, that's when the difficulty starts. But there's another dimension to this, one that's even more hazardous than a basic large deposit. It's an error that well-intentioned individuals make constantly, believing they're actually being clever. And in the perspective of the IRS, that single choice can transform a completely lawful transaction into a government infraction. That's what we're exploring next. Here's where everything transforms and where many honest, law-following retirees unintentionally step into hazardous territory. Let's say you have $12,000 in cash. Maybe it's from selling a boat. Maybe it's savings you maintained at home. Maybe it's money you've had for years and just never deposited. You enter the bank and right before you approach the counter, a little voice in your mind says, "If I deposit all of this at once, they'll document it. I don't want any additional scrutiny." So instead, you deposit $8,000 on Monday, then you return Wednesday and deposit the remaining $4,000. From your viewpoint, that feels harmless, responsible even. You're not concealing income. You're not avoiding taxes. You just don't want documentation submitted with the government. That seems logical, right? But in the perspective of government regulation, that choice can completely transform the situation. This is something called structuring. Structuring occurs when someone deliberately divides a substantial cash transaction into smaller amounts for the intention of avoiding that $10,000 documentation requirement. And here's the aspect that catches individuals unprepared. The money itself doesn't have to be unlawful. It doesn't matter if it originated from your pension, the sale of individual property, or a gift from family. If the deposits are divided particularly to avoid initiating a currency transaction report, that action alone can be regarded a government infraction. And yes, fines for structuring can begin at $10,000 per infraction. Now, let's differentiate this clearly because this is essential. If you enter the bank and deposit $12,000 in cash in one single transaction, the bank submits a CTR. That's it. Standard, lawful, no violation, no fine. In most situations, nothing additional occurs. But if you deliberately deposit $8,000 and then $4,000 particularly to avoid that document, you've just established a sequence that computerized platforms are created to identify. And those platforms are very capable at recognizing sequences. They examine timing, they examine amounts, they examine sequences of transactions over days or weeks. If it appears like the deposits were arranged to remain under the documentation threshold, that's when warning signs escalate rapidly. And here's the uncomfortable reality. The platform doesn't read your thoughts. It doesn't understand you were simply attempting to avoid additional scrutiny. It only recognizes the sequence, and the sequence is what matters. This is where so many good individuals get into difficulty. They believe they're being cautious. They believe they're staying off some imaginary monitoring, but in actuality, dividing deposits to avoid documentation is precisely what places them on the monitoring. Let me state this as clearly as feasible. Submitting a currency transaction report is not a difficulty. Attempting to avoid one can be, and this is the change occurring in 2026. With sophisticated automation, cross-examining, and actual time evaluation, these sequences aren't slipping through the openings anymore. The platform doesn't require a human examiner sitting at a workspace. It identifies discrepancies immediately. It links deposits to tax documents. It evaluates documented income to cash activity, and when something doesn't align, notifications go out automatically. Now, before you let this develop into anxiety, take a breath. The IRS is not focusing on retirees who are simply handling standard finances. The overwhelming majority of individuals who deposit money appropriately, even substantial amounts, never face an issue. The real hazard is miscomprehending the regulation. So, here's the first major understanding. Never divide a transaction just to remain under $10,000. If you have more than $10,000 in legitimate cash, deposit it in one transaction. Let the bank submit the document. That's what the platform anticipates. That's what keeps everything proper. If this is already helping explain things for you, take a quick second to like the video and subscribe. I distribute updates like this particularly to help retirees avoid costly errors before they occur, not after. Because now that you comprehend structuring, we must discuss something just as significant: how to safeguard yourself moving ahead. What basic habits can ensure that even in this fully computerized IRS environment, you're never caught scrambling to justify your own money? That's precisely what we're addressing next. Now that you comprehend where the real danger is, let's transition from awareness to protection. Because this isn't about fear, it's about preparation. The implementation environment in 2026 may be more computerized, quicker, and less accommodating of discrepancies. But the way you safeguard yourself is surprisingly basic. It doesn't necessitate complicated legal approaches or costly shortcuts. It necessitates organization, transparency, and a documentation trail. So, here's the first step, and honestly, this is the most valuable one. Document everything. Whenever a substantial sum of money transfers in or out of your accounts, you want files that clearly justify where it originated from. If you sell your vehicle for $15,000, maintain a signed sales agreement. Make a duplicate, digitize it, store it somewhere secure. If your child gives you $20,000 to assist with healthcare costs, ask her to compose a basic gift statement indicating the amount and that it's a gift, not income or a loan. If you accept a single-sum pension distribution, maintain the distribution documentation. If you remove cash for a substantial purchase, maintain invoices and receipts. The objective is basic. If anyone ever inquires, you can immediately show the origin and intention of the money. Because here's what most retirees don't recognize. The IRS computer doesn't automatically understand the background of your transactions. It recognizes numbers. Your documentation supplies the narrative behind those numbers. And when the narrative is transparent and supported by documentation, issues tend to resolve rapidly. Step 2. If your monetary existence is more complicated than just Social Security and a small pension, this is the year to arrange a meeting with a qualified tax specialist. A good CPA doesn't just submit forms. They help ensure your tax documents tell a complete, consistent narrative. If you had a substantial deposit from selling property, that needs to correspond with what's documented. If you received a considerable gift, they can help guarantee everything is recorded appropriately. Automation identifies mismatches. A tax specialist helps prevent them before they occur. And step 3, communicate transparently with your bank. This one surprises individuals. There's no harm in inquiring your bank about their documentation policies. Actually, openness works in your benefit. If you're planning to deposit a substantial amount of legitimate cash, you can simply do it appropriately and let them submit the required document. Remember, a currency transaction report is standard. It's not an allegation. Attempting to avoid it is what establishes danger. When you combine these 3 habits, documentation, professional assistance when needed, and openness, you dramatically reduce your chances of ever facing that $10,000 shock. Let's pause for a moment and place this into viewpoint. The computerized platforms in 2026 are capable. Yes, they link information immediately. They cross-examine deposits with tax submissions. They recognize sequences humans might overlook. But they are still information-driven platforms. They depend on consistency. When your files are organized and your transactions are direct, you're functioning precisely the way the platform anticipates. This isn't about concealing, it's about transparency. And if you know another retiree, maybe a friend, a relative, someone in your neighborhood who still believes dividing deposits is a clever move, distribute this with them. A basic miscomprehension could cost someone $10,000 or more. Because the reality is, the monetary world has transformed. The old way of doing things where small discrepancies might pass by unnoticed is disappearing fast. We're now existing in a fully electronic implementation era, and the individuals who adjust early are the ones who avoid unnecessary stress. Which brings us to the larger perspective. Here's the larger perspective you need to comprehend. The implementation change we're observing in 2026 isn't temporary. It's not a trial initiative. It's not something that's disappearing next year. Automation is now integrated into how monetary oversight operates. The platforms are quicker, they're more linked, and they're created to function continuously in the background. That means the retirees who are most at danger aren't the ones doing anything unlawful. It's the ones functioning under outdated assumptions. For years, many individuals believed that if something didn't immediately raise concerns at the bank, it probably wasn't a significant matter. If you maintained deposits small, stayed under the monitoring, or handled things quietly, you were being cautious. But in today's environment, attempting to stay under the monitoring is precisely what establishes the monitoring signature. That's the contradiction. One direct $15,000 deposit with appropriate documentation. Standard, recorded, processed, forgotten, multiple smaller deposits made deliberately to avoid documentation. Sequence identified, warning activated, questions created. The platform isn't emotional. It doesn't assume guilt, but it does assume that sequences meant to avoid documentation deserve examination. And when that examination starts, it can be stressful, time-demanding, and costly to resolve. Now, I want to establish this in reassurance. Most retirees watching this will never face a structuring fine. Most substantial deposits, when done appropriately and supported by files, pass through the platform without incident. The objective here isn't to make you nervous every time you enter a bank. The objective is to replace uncertainty with transparency, because transparency transforms how you act. When you comprehend that a currency transaction report is standard, you stop fearing it. When you comprehend that structuring is about intention to avoid documentation, you stop accidentally establishing risky sequences. When you comprehend that documentation tells your monetary narrative, you start maintaining the kind of files that safeguard you automatically. This is really about perspective. The old perspective was keep it quiet. The new perspective needs to be keep it recorded. That single change can save you enormous stress. So here's the question I want you to seriously consider. If a fully electronic IRS platform reviewed your last 12 months of monetary activity, would the narrative make sense on documentation? Would every substantial deposit have a transparent justification? Would every movement of funds correspond with what's documented on your tax documents? If the response is yes, you're functioning precisely where you need to be. If the response is I'm not certain, then now is the ideal time to organize, to submit documentation appropriately, to digitize records, to arrange a meeting with a tax specialist if needed, and to resolve anything that feels unclear. Not because you're in difficulty, but because preparation is far less costly than fines. You worked many years to build your retirement savings. You sacrificed. You planned. You made careful choices so you could enjoy this chapter of existence with security and peace of mind. The last thing you want is a preventable $10,000 fine because of a miscomprehension about how banking documentation operates. The regulations themselves haven't radically transformed. What's transformed is the speed, the visibility, and the automation behind implementation. And the retirees who succeed in this new environment aren't the ones who fear, they're the ones who adjust. So, deposit substantial amounts appropriately. Never divide transactions to avoid documentation. Maintain documentation for significant monetary events. Ensure your tax documents reflect your reality, and treat openness as protection, not vulnerability. Because when your monetary documentation trail is transparent, organized, and consistent, computerized platforms have nothing to question. And that's where peace of mind exists.